Hi, everyone. I'm Doug Alsdorf, the author of Financing Your Future. In this chapter, chapter 4, we're going to be talking about taxes. And there's a number of issues to cover in this, but please don't use the spreadsheets when you're filing your taxes. Rather, just use these spreadsheets as an opportunity to get an idea of what your taxes might be like. And these are useful for us as we look at future exercises such as budgeting and the cost of other issues in our lives. There are three major expenses in life that I talk about in the book: taxes, which we'll deal in this chapter, loans in the next chapter, and then childcare in chapter 6. So, an outline for this presentation on taxes: there are a number of taxes we're going to go through, and I definitely invite you to read the book. I hope that this video is useful as an introduction to the chapter. We're going to start with payroll taxes. I'll explain what those are. They have to do with Medicare and Social Security. Then we'll get into income taxes and spend some time talking about the federal laddering system for taxes. There's capital gains taxes and dividends taxes that have to do with our investments. Then, speaking of investments, we're going to look at the accounts that hold our investments and why tax deferred accounts are highly advantageous for us. And finally, we'll end on property taxes and other taxes, such as sales tax and so on. Property taxes apply when you own a house, and they are a big deal in the cost of a house. There is some tax vocabulary that is tossed around. You'll see the word deduction, exemption, or allowance. Those are all synonyms, and I'll show you where everyone gets the standard deduction of about $14,000 and how that's subtracted from your income. So I'll show you that. But there's another thing called a credit that's subtracted from your tax. There's such a thing as a child credit for a couple $1,000s, and I'll point that out as well. So yeah, I know it's a lot of taxes, and I'm sorry about that. But there's a lot of good things that do come from our taxes, and so I'm not trying to get you to think about how to avoid taxes or anything like that. No, we're just going to pay our taxes and recognize that they are important for a civil society. But there's an easy rule of thumb when you think about taxes. Subtract, say, 25% of your salary. If you're making 48,000, subtract 12,000. You'll be happy though if it's only 20% that you're subtracting instead of a full quarter. So just kind of a quick rule of thumb, somewhere between 25 and 20% is the amount you're going to pay in taxes. So let's start with payroll taxes. And in each one of these slides, I'm going to suggest to you the amount that might be associated with that particular issue. Now, here, payroll taxes refers to FICA, which is the Federal Insurance's Contribution Act. That includes monies for Social Security and monies for Medicare. And you see those two percentages add up to 7.65. Now, Social Security is just a straightforward multiplication of 6.2% multiplied by your actual full salary amount, not the salary amount with a deduction, but the full amount, up to 168,600. So let's say you make $180,000 per year, you'll be taxed 6.2% on that first 168,600, but after that amount you will not be taxed on the amounts greater than that. Medicare, however, that 1.45 still keeps getting taxed. Fortunately, of course, your company is going to keep track of all these taxes, but they're very helpful for us to know about as we begin to finance our futures. So right here already, you know with certainty 7.65% of your income, your job-related income, is going to go to this payroll tax to pay for Social Security and Medicare. Next up, let's now have a look at federal taxes on income, and that could be, 8% or even higher. So already we're up to 15, 16% in taxes, and we're going to work our way through the federal income tax. To understand the federal tax system, let's have a look at what laddering means. There's 7 rungs on the brackets, or brackets, I should say, that range from 0 to 37%. And you can see this in the taxes spreadsheet. I'm actually going to jump ahead one slide right here so that you can see this. If you look in the spreadsheet, you'll see this bracketing. And here are the 7 rungs on the ladder, and there's a range of incomes and a range of tax rates that go along with that. So let's imagine somebody making 62,600. And if we have a look at the brackets, we see they fit right in between here, this rung on the ladder. There's 62,000 fits between those two numbers. And we might guess that they would be taxed 22%. They are not. Rather, they're taxed about 9%. We're going to get this 5,600 number here on the next slide. I'll show you how that's calculated. Now, occasionally you'll hear some random person babbling about, oh, there's a 90% tax bracket, and that's 90% of some filthy rich person's income. It is not. And I'll show you on this laddering system why it's not 90% of their income. It's considerably less. There's different categories of taxes when we look at federal income tax. I'm imagining mostly I'm going to be talking about the single person, but there are married filing jointly. Both spouses file together, and they file one income tax return rather than filing two separate income tax returns. And there's also a category called head of household. We'll focus throughout this conversation about single, but the same principles apply to these other categories. And like I said before, there's a deduction. Everyone who's single gets a 14,600 deduction. Note that these limits, including, let me back up one slide to here, this limit on Social Security does change year to year, just as this deduction amount will change occasionally as well, having to do with things such as the cost of living as well as political actions in our government. So that's what gets deducted. We'll see that coming up. Or if you're married and so on, you'll see these others that are deducted. And finally, here, of course, is that tax credit for children. We'll see that in the spreadsheets. Let's have a look at this laddering idea dealing with 62,600 as your income. So first thing you're going to say is, okay, I'm making 62,600. What's my federal tax? Here we're focusing only on the federal tax, not state and city taxes. So we're going to take 62,600, subtract off the deduction, and so you're actually going to use 48,000 as your ladder. So your 48,000 still fits in the third rung, right? Just barely above 47,000. So you're not going to be taxed 22% though. The way it's going to work is the first 11,600 of the 48, that's taxed at 10%, so that's $1,160. Then the next bit that fits between these numbers, so let's say 47,000 minus 11,000, I'm rounding off here. 47 minus 11, that's 36,000. That 36,000 is taxed at 12%, and that's $4,266. So then finally, there's just a little smidgen, 48,000 minus 47,151, about $900 or $850. That's taxed at 22%. So only that little bit of $800 or so dollars is taxed at 22%. We're going to add up those. We're going to add those blue numbers, add those all together to get to 5613. We're going to add those all together to get to 5613. And so the percentage is not 22%. Again, focusing only on the federal income tax. It's going to be 5613 divided by 62,600 to get about 9%. So yeah, somebody who's making 62,600 is not taxed 22%. At the federal level, they're taxed about 9% because of this somewhat complicated laddering system, but that's okay. It works to our advantage to use that. And of course, I'm just using this to explain how the laddering works. We're just going to use the spreadsheets from here on out. We're not going to go through this laborious process of algebra and calculating. We'll let the spreadsheets do the work for us. So now let's have a look at why taxes, or rather, maybe not so much why, but the fact that taxes are not linear. So let's imagine we have somebody here, and I'm speaking here of federal taxes. Let's imagine we have somebody making $50,000 per year, and here's a screen grab of the actual taxes spreadsheet. And so you enter $50,000 in there, and you enter in some of these other parameters, but let's just focus on the federal income tax. Focus only on that for this point. $50,000 as an income, they will be federal income taxed at about $4,000. Now let's imagine somebody making $250,000, considerably more. Their federal tax is $53,000. So let's put these together into an idea why that's not linear. Have a look here. We have a high wage earner. They pay proportionally more in taxes, so way more than low wage earners. An income of 250,000, that's 5 times greater than 50,000. They're federally taxed at 53,000, but that's 13 times greater than $4,000. So high wage earners are paying proportionally way more than the lower wage earners. Again, this is not a statement of fairness or even why it's done that way. It is a fact of the way the tax system works that high wage earners pay a lot more percentage wise than low wage earners. And we saw that fairly clearly when looking at these two numbers. And you can enter those numbers into the spreadsheet to see them yourself. All right, so that was the laddering system that works in the federal tax system. There are also laddering systems that many state and city taxes use, but my goodness, there are so many cities, and there's 50 states, and I can't make up spreadsheets for all of them. Unfortunately, most of those city and state taxes are much, much lower in terms of a percentage than the federal taxes. So I'm just going to use a straightforward percentage multiplied by your income after subtracting the deduction. That's all I'm going to do. But know that state and city taxes are laddered just like the federal system. So you can Google and find your city tax. It's generally going to be around 1 to 3%. Where I live in Columbus, Ohio, my particular tax bracket in the city of Columbus is about 2 to 2.5%. Sometimes, city taxes are kind of weird. Sometimes those are applied based on you working in the city, but you may live outside of the city. And sometimes they're applied because you live in the city, but work outside of the city. It all depends upon how the taxes are being applied. And like I say, it's generally around 1 to 3% for city taxes. Now, states often also have an income tax, and they are laddered, but they're still generally going to be less than 5%. As it works out here in Ohio, it's about 3%. I'm in about the 3% bracket that I can talk about with you, but I'm just going to use a straightforward 3% multiplied by the income after subtracting deduction. But there are states that don't have an income tax. Yay, let's all go live there. Well, they find other ways to make their money. For example, there are property taxes and so on that are higher. Texas is a popular one to go to because they don't have an income tax, but their property taxes, and in particular their sales tax, is higher. So this becomes challenging. I actually don't think there's that so-called free lunch that comes from living in one of these 9 states that don't have a state income tax. In other words, they'll find a way to tax you. Now, let's take a moment to kind of look at the overall spreadsheet on taxes and just kind of follow these arrows around so that we can see how we can track where you're entering the numbers and how they come out into these 4 important boxes right in through there. So you can do this in the spreadsheet yourself. You can enter 55,000 here. And 55,000, like I say, you do a little Google work, you'll find that's more or less the average starting salary for a recent college graduate, average across all majors, average across the geography, across all of the United States and across universities and so on. So we're just kind of deal with an average situation, 55,000. We're going to subtract off the deduction here, but no children. We're going to assume this person doesn't have any children. So we're going to subtract that off, and this is the actual amount that they're going to be taxed on, and that's the amount that will be placed into the ladder down here if it's between those two values, and the spreadsheet automatically calculates your federal tax at 4,600 and lists that right there. 55,000 though for the FICA taxes, it's charged right on the full 55,000, not on the 40,000. So we're going to take 6.2% and 1.45%, multiply that by the 55,000 and enter that down here into FICA. So that's 7.65% multiplied by 55 gives you this 4,200. Note how FICA is pretty similar to the federal income tax amounts. Over here are my estimates of state and city taxes. And again, you can do a little bit of Googling work to figure out kind of more or less what your state and city taxes. Maybe they're 0, 1, 2, 3%. I'd be surprised if they're greater than anything more than 4%. I'm going to suggest you just use these two numbers. Now what I'm going to do is take them, multiply those by the $40,000 number to come up with these two values you see right here. Then we're going to add those all up right across through there. Oops, sorry. Add those all up. That comes up to $10,000. $10,000 subtracted from the almost 11,000 subtracted from the 55. gives you your after-tax money. This is the money that you have available to you to live on. And you take the 10,000 divide by 55,000, we get an effective tax rate close to 20%, as I mentioned before. Okay, whew. So that's our income taxes. Now let's have a look at taxes on our investments. And these can add up to maybe perhaps no tax, which is fantastic, or maybe even greater than 8%. So quite a range on the taxes on capital gains. What's a capital gain? Well, let's say you've made an investment. Maybe you bought a mutual fund or a stock, even your own house. These are all investments. And then you sold it. Did you sell it for more than you bought it? That's a capital gain. Just the amount that you gained, that's the capital gain. If you sold for less than your purchase, that's a loss. You can actually deduct that. I'm not going to talk about those in this conversation. We're only going to focus on gains. Let's focus on happy things, right? Long term versus short term. Now, so you can have a long term capital gain or a short term capital gain. This is a big deal. Short term is taxed at your income tax rate, meaning you own that item less than 12 months. Long term is taxed at a much, much lower rate than income. It could be zero, actually, in terms of taxes. And only the gain amount is taxed. So let's give an example. Let's say you bought a stock in August 23 for $3,000 and you sold it 6 months later, next year over, but it's still only 6 months, less than 12 months of ownership. You sold it for 3,900. Hey, that's awesome. You made 900 bucks. You're going to add that $900 to your income, and you're going to be and the spreadsheet keeps track of this. There's actually a category in there where it says short-term gains. You would enter 900 in there, and you're going to be taxed on it at your income rate because you owned it less than 12 months. Now let's take that same stock and say you bought it in August 23 for $3,000 and it gained in 23 300 bucks, it gained in 24 300 bucks, and so a year and a half later in February 25 gained another 300 bucks. So it's a total of $900 gain in those three separate years, but that's now longer than 12 months. It's about 18 months or so. Well, taxes are only applied in the year 2025 when you sold it, so not in 23, not in 24, no taxes on it during then. And it's only taxed on the $900 gain, just like the short term. But because you owned it longer than 12 months, it's termed a long-term gain. You may not actually owe any taxes on it. And indeed, if you did like $50,000 income and $900 for long-term gains, there would be no taxes, federal taxes on that $900. Again, state and city tend to have their own rules, which follow the federal, but you certainly would not have any federal income tax. Zero. That's fantastic. So dividends are going to be similar to this idea. There's dividends, as you'll learn in the investing section. That's when the company pays you to own their stock. That's fantastic. And it's usually if you own $1,000 or $10,000 or whatever amount you own, $1 million of a stock, they're going to pay you a percentage of that amount owned, say 1, 2, 3, 4%, not much higher than 4%. Let's say 2% or 3%. The company will pay you back that amount of money. Fantastic. And I talk about reinvesting those dividends throughout the investing conversation. There's going to be ordinary dividends and there's going to be qualified dividends. You see, ordinary are short term and qualified are long term. Very, very fortunately, your online brokerage keeps track of these dividends and whether they're short or long term for you. You don't have to track that, they'll do it for you. Okay, so here's the spreadsheet, and let's take a little pause here for a moment. So let's take a little look at this idea of what are the tax implications of long-term versus short-term capital gains. So here's a screen grab of the taxes spreadsheet. Here you see somebody's making $100,000 a year. Congratulations, fantastic salary. And they had some short-term gains on their investments. Let's say they own some stocks that they bought and sold in less than 12-month period, and they made $20,000 gain on that investment. Fantastic, right? So we're going to enter those two numbers in here and see that their federal income tax is 18,000 or so dollars, but there was no long-term gains. Keep a track of that. So there's over here, we're going to list that right here. Now all I'm going to do is delete the 20,000 and we're going to move it over here to long-term gains. We see their federal income tax drop considerably, but now they do have a long-term gains tax. You add those two numbers together, 8, 13, 8, and 3,000, subtract that from 18,000, we see that the long-term gain person is ahead by $1,500. Even though they had the same income, so to speak, with 100,000 and 20,000 as the short-term gainer, even though they had the same amount of money coming into their pocket, the long-term gainer has 1,500 more dollars because they have long-term gains, long-term taxes on those gains, which are lower than short-term. So that's really something we want to keep track of. I mean, we this is what happens. We get all excited about something we see on the internet telling us how we're going to make all kinds of money in a very short period of time. But those investing schemes that we call day trading and swing trading, they often don't tell you about the tax consequences. So let's imagine we have somebody who's doing short-term investing and another person doing long-term investing. And here again, I'm only focusing on the federal taxes. So there's a $1,500 short that the short-term investor, they're 1,500 bucks less than the long-term investor. They got to make that up. Their investing scheme has to be better than the long-term investor. So let's imagine the long-term investor made $20,000 over the long term, longer than 12 months. So that would be, say, 10% multiplied by 200,000. And you'll learn in the investing section that over the long term, the US markets, when reinvesting dividends, have actually made 10.5% over decades and decades and decades of averaging. But let's say if you're a short-term investor, less than 12 months, how much money, how much investment gain do you have to have in order to make up the 1,500 bucks? Well, you might think that, well, it's 21,497, just to add 14 to 20,000. But remember, now you're going to be taxed on 21,497 of the short-term rate. You actually have to keep iteratively increasing it to 21,970 to actually have the exact same amount of after-tax income for the short versus the long term. You can do that in the spreadsheets. What you're going to need to do is just go into the spreadsheet, enter these numbers in here, see what the totals are, subtract them, and then get to this 21,970. I invite you. That's a little iterative process you can do. The key here, though, is this. 10% is the gain or investment gain that a long-term investor needs to get in order to make the exact same amount of after-tax money and so on. The short-term investor must get 11%. Now, that 1% difference doesn't seem like that much. And maybe occasionally the short-term investor can actually do that. But as we'll learn in the investing sections, it's very difficult to do that consistently year after year after year after year after year. That's the key here, year after year after year. So as it turns out, making up just even 1% is difficult to do. And this is a long-winded sort of professorial rant to encourage you to think about investing schemes that focus on long-term gains and hence the lower taxes that come from them. But fortunately, turns out our tax deferred accounts, IRAs and 401ks, you can invest inside of those, have short-term gains, no taxes during the investing time. But when you withdraw, you're going to delay. In other words, you're delaying those short-term gains taxes to when you withdraw the monies in your retirement. So that's what I mean by delaying these short-term taxes if you're using a tax-deferred account. You're delaying the short-term taxes to when you retire and are withdrawing the money. Still got to pay the tax man, and it will be short-term gains when you retire, but you didn't pay those during the investing time period. So here's a review of taxes. Let's imagine we have a couple. They have two children, and let's say their combined income is $150,000, and they're going to be married, filing jointly. I need to move this Zoom. You can't see it, but there's a little Zoom toggle thing that's in the way. So their combined income is 150,000. Maybe they're both making 75 apiece. But let's say they've got some qualified dividends, meaning long-term taxes on those. So total income of 200,000. The spreadsheet also says, okay, they entered in two children, so they're going to get a $4,000 deduction when married, filing jointly, actually, no matter which category they fall in. So the spreadsheet keeps track of all of this, figures out their taxes for them. So right in through there, they've got about $30,000 in taxes. But over here are the taxes that are on these dividends over here, about $10,000. And again, I don't know for sure what your state and what your city will do with taxes on the gains when it comes to investments, but I'm going to be conservative here and just assume they're going to go ahead and tax them at the 3 and 2% rate. Over here, we're going to see the federal long-term taxes are calculated separately. If you go in the spreadsheet, you see that there's actually categories for that, just like there is for your income. So, okay, there's the federal long term. So now we have this question of there's $10,000. Is there a way to avoid paying that $10,000 on the dividends and investments? That's pretty exciting. There is a way to avoid paying $10,000 in taxes, and that's year after year after year. So fantastic. How do you do it? You invest inside of your tax deferred accounts. Tax deferred accounts, you've probably heard of these individual retirement accounts and 401ks. 401k is offered through your place of employment. Your IRA is you yourself. It's your individual retirement account that you can create by working with an online brokerage like Schwab or Vanguard. So you put your monies inside of these and you are able to avoid taxes. So the really, what I'm about to say is a lot of babble, blah, 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 right? I mean, this whole conversation on taxes can be really boring, but it's going to save you a lot of money. So it's important to pay attention, maybe rerun the videos, reread the chapter. So read, read, read. Read chapter 4 to learn about tax deferred accounts. Read chapter 14 to learn even more about tax deferred account. So what's a taxable account? What's a tax deferred account? Well, you're probably already familiar with your checking account. That's a taxable account. The money is taxed before going into the account. So let's say you're working for a company, they're going to remove income taxes from that, and then whatever's left over, you can put into your taxable account, just like you put into your checking account. The gains inside of the taxable account, those are taxed, so long as you push the sell button. If you don't push the sell button, there's no taxes. So you're only gained when you after you've sold. But when you withdraw the money, no taxes, no problem. Correctly invested, then, meaning long-term investments, buy and hold is the strategy language that we use. Taxes will be long-term based, and those are very low taxes, but you pay the taxes before you put the money in. Or you can use a tax deferred account, an IRA or 401k, and delay the taxes until retirement. So now you've got a job. The money is going into the tax deferred account, a 401k or IRA, but it hasn't been taxed yet. Investments inside of the account. So let's say you're buying and selling inside of the account, short or long term. There's gains. Those are not taxed. But when you retire and you're starting to tap that IRA to live off of the monies in it, that's when the taxes are applied and they are at the high income tax rate. And a little sidebar here. Let's say you do all that investing inside there. You get all excited. I don't want you to get excited about day trading, but let's say you do, and you think, "Wee, I got all this extra money." You're doing it inside the IRA, so you're not being taxed on it. You can't access that money until you're 59 and a half years old, unless you pay the 10% penalty, which is pretty hefty. We already saw 1% was hard enough to make up. Now imagine 10%. So the question becomes, well, which of these is better? Got a taxable account, money going in has been probably taxed. Withdrawals are not taxed, although the gains were. On the other hand, we're going to delay the taxes with a tax deferred account and not pay the taxes until we withdraw the money, but at a high income rate. Which is better? Chapter 14 goes into this and it demonstrates for you that because of the tax advantages, generally speaking, your tax deferred accounts are awesome, particularly if you get a company match, which I'll talk about in just a second. So that is really powerful, and I highly encourage you to invest into your tax deferred accounts. But I do like my taxable accounts. I have both. And I really like my taxable accounts because, as you'll learn reading in the book, I can now pass those taxable accounts on to my son and he'll pay no tax at all. None. No capital gains taxes, nothing. It's called a step up basis, and I invite you to read about that. So that's a way that we can pass money on to our heirs and give them a big head start in life. So let's imagine We've got a lot of tax babble that I've just gone through. I really want you to rerun the videos. I really want, rewatch them, and I really want you to read the book carefully because this is a huge expense, and there are ways to just be thoughtful about your taxes and save money by not getting involved in, say, short-term gains taxes. So let's imagine two people. Both are making $75,000 per year, and they're going to invest for 35 years. You'll see that in the book where I say that's a good target number. Let's imagine person A, they're investing $10,000 in their 401k or even in their IRA, but there's a limit on how much you're allowed to enter into your IRAs. Right now it's $7,000. So let's imagine, but 401ks have a higher limit. So let's say they're investing their $10,000 per year in their tax deferred account, their 401k. Person B, they said, no, I'm not going to take that 401k. Turns out they're only going to have about $7,300 to invest. And we'll see that in the spreadsheet coming up. So there's a couple of questions. How much more money can be made because of this additional amount, $2,700, in a tax deferred account compared to the taxable account? How much more can you make over that 35-year period? And then how about this company contribution? As you'll learn about in 401ks, read more about them, Google them. Often what happens is you go work for a company and they'll say to you, hey, we'll open a 401k. There's a long history of why it's named 401k. You can read the wiki page on that. But anyway, they open this thing called a 401k and you partner with your company and you can invest in a few very, very basic, maybe 10 or a dozen different investments. They're going to be funds that you can invest in, not individual stocks. Most 401ks won't let you buy individual stocks. That's okay. That's actually better. But so you buy a fund inside of that 401k. Your company, not only are you putting your money in there, many, many companies will match some small percentage and they'll put money in. It doesn't come out of your income, it comes out of their pocket. It's free money, in other words. So let's see the advantage of that as well. So here's our person. This is person A. And now we've gone into yeah, there we go, person A right there. Now we've gone into the spreadsheet, entered their full income 75,000. They're going to now put $10,000 into their 401k. We see that they don't have any children, but we're going to take 75,000 minus the 10,000, that's 65,000, then minus some more money here, 14,600. So this is their actual laddered bracket income. And we see that their after-tax money that they have in their pocket is 50,600. That's how much they have in their pocket to go live on and do things, but they are still investing $10,000. Here's person B. Person B says, no, thank you. I don't want the 401k from the company. I'm just going to do $75,000. I'm not going to take the company. They have $57,900 in after-tax money. They are in a higher tax rate, 22, 23%, compared to the person who is contributing to their 401k. They're at 19%. That ends up being 50,600 for, but still investing 10 grand, 50,600 for person A. Whoops, sorry. 57,900 for person B. Person B can only invest $7,300 to live on this same amount. We want them both living on 50,600. So we got to subtract off 7,300 here from person B to get to 50,600. So they both live on the same amount. We're going to do an apples to apples comparison. So person B is investing $7,300 per year. We're going to say, you know what? We're going to keep them, their salary is going to keep up with the cost of living, at least up with inflation. So we're going to grow their income at 2% a year, which means they can grow the 7,300 contribution at 2% a year for 35 years. And let's just say conservatively, they've got some investments going on, and over a 35-year period, the market performs at 7%. Again, you'll learn later on that market performance over decades and decades and decades has been better than that, but still we're going to be conservative in our thought process here. Add that all together in Formula 4 from the investing formula spreadsheet, and they add up to $1.3 million. Compare that now to the person who was able to invest $10,000, incrementing that at 2% a year and gaining in the investment category and the investment growth of 2%. So this is a cost of living increase. 7% is the investment growth for 35 years. Wow, they're already at $1.7 million. Already considerably better, nearly $500,000 better. Wait, it gets even better for the person A who's working in their 401k. Let's say their company will do a 3% match. So they're making $75,000 per year, and their company says, we'll put in 3% of your 75,000. And I've heard numbers right around in that category, 1, 2, 3, 4%. So let's say 3%. You can find out from your company how their matching works. So 3% of 75,000 is 2250. We're going to say they're going to increase their salary at least at the cost of living, so that's 2%. They're going to get that same investment growth rate, that's 35 years, nearly $400,000 free money coming from the company. You just say yes. Yes, please. I'd like my 401k. So this person, add those two numbers together. Person A is $2.1 million. Person B, who did not use the 401k tax deferred account, has $1.3 million plus minus. We're talking an $800,000 to $900,000 difference. Turns out that's incredibly valuable and really worth it, even at the higher income tax rates at withdrawal during retirement. That's a phenomenal amount of money to have. And I hope this is a very powerful slide demonstrating for you in terms of just looking at numbers and seeing how valuable 401ks are, provided that your company is making this match. This is a very important match, and they should be doing that for you. Okay, whew, there we go. We're all done with those income taxes and investment taxes. And I know that was a lot of tax babble, but I hope I'm making it clearer for you. Now let's wrap this up by talking about taxes on property and then sales taxes. Taxes on property are 1 to 2%. Doesn't sound like much until you realize that's on the value of a house. We're talking $500,000 houses, $1 million houses. That's a lot of money. California, man, they're about 1%. So the $1 million house in California, that person's paying about 10 grand a year in taxes. 10 grand a year in taxes. You move to Texas or Ohio, turns out it's a much higher property tax rate. And this often surprises people who move from California to, say, Texas. They get all excited. Yay, no no income tax, right? No income tax in Texas. I'm going to move there. And then they get shocked when they're paying twice as much in property taxes. It's a real eye opener for people when they see that. So it's really hard, though, to figure out property taxes. You can Google and figure out some of it, but it really doesn't help. Instead, what I invite you to do is go into Zillow or Realtor.com, click on some houses, scroll through the house, and see what the taxes paid were for the past several years. Not just 1 year, but go back several years in the history. And Zillow and Realtor.com will show that to you. And you'll see this is a little suburb around Columbus, Ohio called Grandview. I did this a couple years ago. A $500,000 house there had about $8,700 in taxes. That's nearly 2%. And here's another suburb around Columbus. Their taxes were a little more than 1.5%. Another suburb, their taxes were 2%. Look at this. These are all suburbs straight around Columbus, Ohio. They're just hardly, maybe only 15 minutes from each other. Look how big the tax differences are. It's really going to pay off for you to really look closely at this when you go to buy a house. And these property taxes, you often don't think about that extra, looks like almost an extra $2,000. You may not even be thinking about that when you go to buy a house. So property taxes are important. You'll see when I start talking about loans in the upcoming chapter that I thinking you should plan on, 1.5%, 2%, something like that for just the property taxes. Okay, finally, let's talk about sales taxes. Now, sales taxes are applied to things you buy. Now, some states, they don't have a sales tax. There is no federal sales tax. Now, Ohio, it's 5.75%. California is higher. Texas is higher. Local municipalities, cities, and so on, they might add their own taxes. Yeah, it really starts adding up. So let's say in Ohio, you buy something for $100. You're going to pay an extra $5.75. And you're probably already familiar with that. You've probably bought some stuff, seen the taxes applied, and so on. If you spend about $5,000 on taxable things, that means you actually paid $4,700 for them and had about $270 in taxes. There's one that I'm kind of familiar with because I'm an earth scientist and I deal with oil and so on. Gasoline tax. We often kind of ignore that. We just go to the pump, pay the price. Well, there's a lot of federal taxes being applied. That's 18 cents a gallon. States will be anywhere from 20 to 60 cents a gallon. Look, Ohio's around 40 cents a gallon and California is close to 70. In Texas is much lower, right? So you can get those from the EIA. So, you can kind of do a little bit of algebra and you come up that if you're buying about 500 gallons of gas, you're paying about 285 bucks in taxes. There's other taxes, things applied to getting your driver's license and taxes on your car and on it goes from there. So altogether, you're talking about another $1,000 or so in taxes. Yeah, there's a lot of taxes. Let's wrap it up. Let's end this video. I've had a lot of fun telling you about taxes, but let's wrap it up so we can get to much more interesting things. Taxes, income taxes. Already you know you're going to have 7.65% of your full income being taxed for FICA. Your federal, even after subtracting off the deduction, could be as high as around 10%. City and state combined, you're probably going to be around 4%, depending upon where you live. Sum those all up, you're around 20 to 25% in taxes, just subtracted from your income straight away. For example, somebody making 75,000, you go in the spreadsheets, you'll see that they're taxed close to 23%. There are investment taxes. Short term, that's similar in terms of the rate. It's actually the same as the rate for income taxes, but no FICA is applied. After we've subtracted off this FICA up here, no more FICA is going to be subtracted from your investments. So if you had a $50,000 gain in less than 12 months, it's taxed at 11.6% for about $5,800. And I'm adding that includes federal, city, and state. And like I say, city and states are going to be highly varied, but far, far less in terms of the total percentage than federal. But if you owned it for more than 12 months, long term, $50,000 gain, there's no federal tax on a $50,000 gain, assuming you had no other income at all, just simply the $50,000 from the investment. Imagine having investments, long-term investments, and you pay no federal tax. You're living off 50,000 if you can, live off $50,000 per year and pay no federal tax. You may not even pay city or state taxes, really depends upon where you live. And like I say, I'm being conservative and saying, well, maybe you do have to pay a little bit for that. Look how big that difference is. What is that? About $4,000 there in terms of a difference between those two? That's a pretty important difference. Okay, taxable investing accounts, money going into, it's like your checking account, money going into the account was probably taxed at your income rate. In other words, you had your income, you subtracted off all these taxes, and then whatever was left over, you put into your taxable account. Taxes while in the account, either short or long term, depending upon how long you bought and then held and then sold, depending upon that timeline. That's either short or long term. Not all money is taxed, just the gains, but no FICA. That's good. And there's no taxes on the money coming out. Tax deferred accounts, money going in the account, not taxed. No taxes while money is in the account. That's great. But when the money comes out, all of it is taxed. Not just the gains, but the full amount is taxed at an income rate. So that's a much higher tax. And hence, we really want to grow the amounts of money inside of these tax deferred accounts, grow them for as big as we can get them before we start tapping them. And you'll learn about that in chapter 14. There's some other taxes. This is a big deal. We tend to almost forget about it, ignore it, but property taxes are a big deal, and you'll learn about that in the loan section. And of course, you have all these other small little taxes. Even you buy a car, turns out taxes on cars are actually higher than the tax rate listed here for Ohio. There's actually a little extra just because it's a car. Yeah, there's a lot of taxes, but I'm glad you joined me on this little tax adventure that we've gone on here. And like I say, I invite you to rewatch the videos and reread the book to really understand the importance of this major cost in our lives.